Good morning, everyone, or good day. Well, for us, it's good evening for me and Robert. I'm not sure if anyone else is in the Far East. So we thought of doing a small panel on what we call liquidity regimes in China. And the idea really came from Robert, who has done an interesting piece of work on this already last year. Which was quite inspiring for me to also start thinking about how it all fits for me. I've heard Johannes speak at NYU Shanghai, I think it's more than a year ago now, on his project with regard to capital markets in China and offshore capital market as well. So we thought this could be a good opportunity for us to, well, expose you to a little bit of our work, and then more than that, have a conversation on liquidity regimes in China. And when we say liquidity regimes, we mean precisely, and let me share for a second my screen for this, just so that we are on the same page about this concept. We are looking at Fabian Pape paper from 2020, where he basically introduces this question very much within the money view framework, how states and their central banks situate themselves within the payment system has significant consequences for which trades can be made profitably and which actors gain in importance over time. In this sense, liquidity is more productively understood as a fault line in the governance of monetary relations that touches upon broader and deeply political questions about the organization of the payment system. So this has been the kind of initial concept we wanted to address here. And well, without further ado, let me just introduce our speakers for a second here. So Robert Pauls teaches at Xi'an Jiaotong-Liverpool Jiaotong University in China. He's a political scientist and works within, let's say, political economy, and has been drawing on money view a lot. Johannes Petry, I think you guys know quite well by now. He's at Goethe University in Frankfurt, has done his PhD in Warwick. He's also, I would say, international political economist. I don't know what would be the best way to introduce him. Has been running research on Chinese financial system for quite a while now, and currently is a principal investigator for a big project on China's capital markets. So our idea was to start with Johannes, who will tell you a little bit about in the monetary hierarchy, the highest level, right, the international level. And then we would have Robert talk about People's Bank of China, so going a little bit down in the hierarchy of money. And then I'll talk a little bit about real estate in China, as that has been a big topic, and I've tried to follow it. And then we would have a short discussion amongst ourselves and open for everyone to join in on this general question of liquidity regimes. So with that, Johannes, please start.
Great, thank you for the introduction. So I'm going to share my screen, and what I want to present today is kind of a few guiding observations on how we can situate China within this kind of this discussion on liquidity regimes and kind of global financial markets, etc. So this is a part of my kind of current book project that's titled Capital Markets of China's Characteristics, that looks at how capital markets in China have been developing over time and integrating with the global financial system. And I mean, there is a common assumption about, if we talk about capital markets, that kind of there is somewhat of a separation between the state and markets. The state is rather provides a framework for markets, but does not too actively intervene into them. Of course, they do so, and this is being questioned in current research as well. But I would say that what we see in China is quite different from what we see in, let's say, in the US or Europe. There's a lot of discussion about the liberalizing effect of capital markets, a lot of discussions about convergence and how they're quite uniform entities. And some of these assumptions, I think we have to question when it comes to China. And this applies also to money markets, I would say, and different aspects of capital markets as well. So that's kind of the broader framework that I want to provide, and also how kind of China is integrating into the global financial system given this background. So we think about the financial system in China, it was quite bank-based, and capital markets did not really exist until the 1990s. Now they're the second largest capital markets in the world, be it for bond, be it for stocks, be it for futures markets, I think third largest futures. And there has been quite integration with global finance. In the last 2 years alone, 2020, 2021, almost $300 billion were reallocated towards China. This has been picking up more recently again after a few outflows in 2022. And we can really see China integrating with global finance. To give you a bit of background, I mean, we can really see a post-crisis shift in China where capital markets have become much more important since then. So just if you look at a few indicators of the growth of capital markets, be it the total value of traded stocks, market cap, the GDP contribution of finance, China's kind of share of global derivative markets, you can really see that this has been increasing massively. It's almost on par with the US in some of these kind of different measures. So how can we kind of explain the growth of capital markets in China's economy, which is societally non-liberal, as we all know, and how that relationship with the global financial system is kind of being formed in the process? So the approach that I'm taking here, and I won't go into too much detail, is really to look at how these markets are organized differently on a kind of micro level and institutional level. So this is why I think it fits quite well with this idea of the kind of liquidity regime and how the kind of public-private institutional configurations that govern financial markets have emerged. And on a micro level, I really look at how exchanges organize markets. So not the exchange as a marketplace, but really as actors that decide about the rules of the game, right? What can be traded on markets, who can trade on markets, what are the rules according to which trading takes place, and all of that. So really looking at these market microstructures and how they differ in China compared to kind of global markets. Then this kind of organization of markets itself is based within a certain institutional setting. And this is where the kind of institutional logic of state capitalism comes in, as I call it. So if you think about kind of global capital markets, right, it's very much about enabling private financial actors to create profit, as also the definition that Sasha just read us highlights, in order to create efficient markets, right? And so the state provides a framework for that and facilitates that, but it does not really actively intervene and tries to steer markets. Because this is much more what we see in China. We see much more control of market activity, and also the market trying to use these kind of infrastructural arrangements of how the market works to steer market outcomes towards certain national development objectives. We can see a few characteristics of this institutional embeddedness of kind of the market and its kind of organizers. Exchanges are government agencies, they're shielded from competition. They're embedded within kind of party structures such as the internal promotion system, the nomenclatura system. So we really see that the defining difference between kind of these kind of different logics is not whether markets exist per se, but rather the ideas that underlie market organization and kind of the actors that shape and dominate these markets and how they work. So that's kind of the broader framework, which in the end gives us kind of three different dimensions to look at. And I'm going to look at number 1 and 2, which is how markets function in China and how they're being integrated with kind of global financial activities. And I'll leave the kind of internationalization out in this presentation. So if we think about these markets in China, we can really see that they provide an alternative to how global markets function. And this goes back, I mean, if we look at how these markets really work, if we look at account structure, margin requirements, position limits, trading rules, regulatory oversight, and I mean, there's 20 other 50 other things we can look at, is that we really see that the logic that drives how these markets work and how these markets are then kind of created and organized really differs quite a lot, right? In global markets, we have omnibus accounts. In China, we have individual accounts, which can be tracked to an ID card, in theory. You have kind of portfolio margining or full margining in China, and margins are also used to monitor trading. There's position limits are really strict in China. They're enforced across all products. They're very extensive. You have order limits on how much you can trade. Order types are kind of restricted. There's hedging quotas for certain products and so on. And there's kind of a lot of regulatory oversight. And this is really kind of, these markets function differently because there's also a very different role for the market, which is, as was often noted, to serve the real economy, contain financial risk, or deepen financial reform. So it's really about these national development objectives in a way. So serving the real economy is a huge focus here. This is from an exhibition center of one of the exchanges, and you can really see how a lot of the market structures are geared towards that. Similarly, there's this whole kind of monitoring and intervention system, which enables the regulators to really swoop into markets and basically turn off the turn off the tap, and basically the market is dead. This was the most traded futures contract in the world, I think, index futures contract 2015, CSI 300, which was then basically killed by overnight by the regulators, but also because they have the ability to do that through these different market structure arrangements. And part of why they do that is that the market also has a very interesting social function, that retail investors are quite important, right? And that's one of my interviews noted, and this is something that came up quite often in my research, is that the retail investors are viewed as kind of the little kid, which can be doing nonsense, doesn't know what it's doing, is unreasonable. So they have to do something to protect them. So a lot of market measures are, so there's a lot of volatility in the market through these retail investors, but there's also measures to kind of professionalize the market, to make it more institutional and international, but thereby still maintain that element of control. So you do see change within that setup. And also, but still the kind of logic of how the markets work and the role of the state maintains quite relevant. So we see this internationalization, right, or this integration of China within global markets, which was quite a parallel system for a long time. You could only go onshore through basically Chinese company, a JV, and you had this kind of step-by-step approach of opening up, of cross-border integration, with substantial inflows of global capital and actors. First through a very cumbersome system, the QFII and RQFII quota system, then the Stock Connect, and now this kind of multi-asset connect system that allows more seamless access, but maintains these Chinese logics of how markets work. So just to give you a few examples of some of the kind of changing patterns, you have a huge rise of kind of foreign ownership in these markets due to index inclusions and Stock Connect, which are kind of linked. You have a similar picture for the bond market as well, where kind of now ownership of Chinese government bonds is at almost 12%. You have a much more larger role of global investment banks within China. Their activities have increased in both number and also kind of size and what they can do in China. So you have a much larger presence of these global financial institutions. But this is all done in a way in that it facilitates national development, but it also enables the control of these activities. So kind of the system that has been enabling a lot of this international activity, the Connect system, is really a closed loop, right? Capital controls are intact, home rules apply, so there's no day trading, speed bumps, there's lots of monitoring of trading activity. They can always kind of stop the trading if they want to. So in a way, they managed to kind of open up the market while maintaining that very strong role of the state of how the financial system works. So we do see a change within that system, but in a way we see a lot of kind of path dependency and persistence of these state roles. I won't talk about the international dimension where we see a kind of expansion of that to a certain degree, but to conclude, we really see kind of emergence of different markets in China that not only represent an alternative to global markets, but also resist pressures to conform with them, which leads us to kind of, or should lead us to rethink some of these discussions that we have about financialization and neoliberalism and kind of capital markets and how liquidity regimes might be kind of varied. Thank you.
Thank you, Johannes. This was really great and on time. Now let's hear Robert.
Okay, thanks. All right, can you see what I'm sharing? Wonderful. Yes. Okay. So thank you very much, Sasha, for organizing this panel and for inviting me to it. And thanks, of course, also to the organizers. This is a really nice and quite spontaneous opportunity to present some recent research that I've been working on. So Sasha said that I've been working with critical macrofinance and the money view for quite some time, which might be true in terms of my reading, but this is the first paper that I actually tried to get published that uses this kind of framework, right? So I'm by no means an expert, but I'm trying to kind of connect and research on the Chinese financial system with this kind of theoretical framework. So the paper is titled Market Maker of First Resort, the People's Bank of China and the Rise of Market-Based Banking in China. And this ties in nicely with Johannes' introduction to the, on the one hand, the rapid growth in Chinese capital markets. So the Chinese bond market is now the second largest in the world, both in terms of absolute volume and in terms of its share to GDP, or yeah. And basically what this paper does, it shows how the People's Bank of China, or what the role of the People's Bank of China was in the creation of that bond market. So I'm trying to give you a very brief overview of the argument here. So as everybody knows, we see the rise of shadow banking in China after the 2009 stimulus package. And this shadow banking has undermined the People's Bank's ability and regulators' abilities to manage, on the one hand, financial stability, and on the other hand, also, it has undermined the effectiveness of monetary policy. And as a response, the People's Bank and regulators then push shadow banking into bond markets and create a bond market in the process. And that's like a two-pronged process. It's on the one hand, a regulatory push over a long period, like about 10 years or so, probably a regulatory push that still hasn't quite concluded yet, but I think like the main contours of it are now clearly visible, and a monetary policy push. And I'll talk about both briefly. And the aim of this, and we can maybe debate to what extent it is successful, is to restore the People's Bank's control over the financial system while avoiding deleveraging and preserving or entrenching existing hierarchies within the Chinese financial system, preserving who benefits from it within the context of the overall investment-led growth model. Okay, wait. So, yeah, Chinese shadow banking is different from shadow banking in the West. So it's not market-based. It's bank-based, so this is why it's often called like the shadow of banks. It emerges to evade tightening monetary policy in the wake of the 2009 stimulus, and the main feature, I think, is that of Chinese shadow banking is that banks turn to the interbank market or to interbank lending more broadly to expand assets and liabilities of their regulated balance sheets. And in this process, shadow banking creates new mechanisms of liquidity generation via interbank lending. So what I would like to define Chinese shadow banking as is as interbank funding of lending to non-financial corporations. So that is, I think, what the essence is of Chinese shadow banking, and what also makes it so makes it a target of PBC and regulators' policy then, right? We have, on the one hand, a class of or different types of shadow banking assets. So this is a very abstract view of this. For example, entrusted loans or repurchase of discounted bills, where commercial banks and non-bank financial corporations make loans to non-financial corporations and move that loan off balance sheet via interbank borrowing and lending. So here, an interbank peer becomes the ultimate lender to a non-financial corporation via a number of hops. And then, for example, we have trust loans, where a trust finances a trust loan by selling trust beneficiary rights to a commercial bank, which in that process creates a deposit, right? Through interbank business channels, which are at that point in time, at least, also regulated in a way that this business is off balance sheet. And again, the commercial bank here becomes the ultimate lender. And what these shadow banking mechanisms do is they create basically bank deposits M2 by commercial banks via interbank lending. And this is what undermines the effectiveness of the PBC's monetary policy, which until the mid-2010s is still mainly relies on various quantity-based tools. And then on the liability side, we have as ultimate liabilities either interbank liabilities or wealth management products and trust products, which try to fund interbank assets through retail investment liabilities. And this is another point which awakens the people's banks and regulators' ire, which is because it creates instability via this whole problem of maturity transformation. So this instability becomes visible during the 2013 liquidity shortage, where the holders of interbank assets had trouble rolling over their liabilities, which led to a spike in the not only the repo rate but the interbank rate more generally. Some say that this was a signal engineered by the People's Bank actually, but whether or not that is true, the structural conditions for the engineering of that signal had to be there already, right? So this signals, I think, to the People's Bank and regulators ineffective control over financial stability. So the quality of shadow banking loans was increasingly questionable, and the ability to roll those over, to roll the financing over, what was becoming increasingly fragile. And it showed how ineffective control over credit creation had become. So as shadow banking evaded the People's Bank's monetary policy tools. And the People's Bank then and other regulators, they respond with a two-pronged regulatory monetary policy push of shadow banking into bond markets. So the regulatory push, this is like a very abstract synthesis of this regulatory push. And a gross simplification as well, but very helpful, I think, for understanding what has happened is to look at what regulators defined as non-standardized credit assets and standardized credit assets. Non-standardized credit assets mostly being all of these shadow banking assets like trust loans and trusted loans, where regulation over a period of about 10 years on the one hand curbs the financing or reselling of these, repackaging of these as wealth management products. Regulations curb the link or sever the link between banks making loans to finance shadow banking assets. They curb the link between these shadow bank assets and interbank lending or the interbank market. And they basically force whoever holds these assets to move them all on balance sheet. So what the point of these regulations is to sever the link between interbank lending and lending to non-financial corporations, which is, I think, the main characteristic of Chinese shadow banking. So this is what the regulators want to get rid of. And on the other hand, we have these standardized credit assets, which are bonds, repo deposits, and all kinds of other assets, which receive favorable risk ratings, which can be repackaged as or resold as wealth management products, where access to the interbank market is expanded and facilitated, and which is generally accepted as collateral by the central bank, by the People's Bank in their open market operations and through their lending facilities. So this is basically the creation of market-based banking, banks making credit in bond markets, so financing bonds in the interbank market. So that is the regulatory push, and then we have the monetary policy push. So what we have here is a graph of the spread between repo and treasury bonds. And as we can see, before 2015, this spread was quite volatile, often going into negative territory. Whereas after 2015, the spread becomes much more stable, and there's like a consistent positive spread between short-term repo and long-term treasury bonds, which allows the holders of bonds to reliably finance these through the interbank market. So where does this change come from? I would argue it comes from the PBC becoming a more active participant in the interbank market. After about 2015 or so, this is the blue line here, it becomes a net repo lender. And also the volume of its open market operations increases, which you can see in the gray bars here. So it becomes a net lender in the interbank market through its open market operations, through its repo, and it also becomes a huge net lender in through its lending facilities, right? So this also starts in 2015. So this is kind of the monetary policy push. The People's Bank, by being a net lender, creates a stable and a positive spread between short-term borrowing in the interbank market and the interest rates of earned through long-term bond assets. Why does the People's Bank do that? Well, it does that firstly because it is, since the 1990s, tasked by law to create a bond market, but hasn't been able to do that until the mid-2010s or so. And then, of course, through the bond market, the PBC can address various of its monetary policy goals, which, aside from managing the price of money and financial stability, includes a role in fiscal policy, industrial policy, and yeah, as I said, the development of financial markets. To conclude, what are some of the implications maybe from this for understanding China's liquidity regime? Well, we had Chinese shadow banking, which tried to relax liquidity constraints through interbank lending and regulatory evasion, interbank lending to ultimately non-financial corporations. And this is being replaced by what we could call maybe Chinese market-based banking, which relaxes liquidity constraints through the expansion of the central bank's balance sheet. The People's Bank now maybe effectively controls risk and credit through its monetary policy and through its balance sheet. However, this puts the People's Bank at the center also of political and distributional struggles over China's investment-led growth model. Right. So on the one hand, for example, the PBC is effectively de-risking the bond market, in my opinion, benefiting bond issuers such as real estate and local governments, right, and benefiting the big state-owned banks, which are net lenders in the interbank market. Then another question is how can the People's Bank ever retreat from this net lending position without undermining the investment-led growth model, especially in a time where we have a slowdown in growth? So the question also arises: can the PBC ever tighten, right? And related to that, of course, can we ever introduce market-based pricing or risk without a broad political consensus to reform the growth model? So overall, I would say, in terms of understanding China's liquidity regimes, liquidity regime, I would find that what we're seeing here is a change in form, right, of the liquidity regimes by the emergence of capital markets or bond markets in particular, but not really a change in substance. Okay, that's it. Thank you very much.
Thank you, Robert. Okay, so I'm gonna go ahead and do my part here. I wanted to show you a little bit about Chinese real estate market, and I have a much longer presentation here than the one that fits this time frame. But basically, the idea was first to develop the kind of real estate balance sheet scheme, which I'm not going to go through, but just give you an idea. Basically, we have the developer that is borrowing to buy land and borrowing to get the construction company to create the real estate, and then a household that borrows on a mortgage to buy this real estate, right? And then this simple model depends on basically household repaying the mortgage loan and real estate price being high enough to cover for land price, construction, services of the construction company, and interest on borrowing. Now, if we take this kind of model, we can see kind of the basic distribution of risks throughout it. But yeah, if we take it to China, we see that really, basically the price has been growing up to 2020, and this has been really the driving force behind the growth of the sector. And this is true of all kinds of cities. And now, when we contextualize the crisis we have at the moment, it is really the tier 2 and tier 3 cities where Evergrande, the big real estate developer, has been kind of specialized, are the ones where prices have been falling, while in the first tier cities such as Shanghai, Beijing, Tianjin, they are still growing, albeit much less than they did before. And here I go through all kinds of kind of basic indicators on all these participants, the households, the real estate developers, the banks. What then becomes interesting when we move from this kind of general model into the story of China is to trace how the specific model operated in different periods. And we provide here three versions. One would be the pre-2008 operation. In China, local governments own the land, and they basically repurpose this land for real estate development, and then lease it off for like 100 years. And the way that this should work is basically that they develop infrastructure to kind of prop up the real estate price in these specific areas, right? So this is the mechanism we're dealing with. This is very small, and I'm not going to walk you through it. If you're interested, I can share the PowerPoint or discuss it with you further. But the idea is that that basically we have these local government funding vehicles which are set up to develop infrastructure. At the same time, the other specificity is that you have these pre-sales. So basically, people borrow to buy claims on future real estate. And so real estate developer who would, in that initial model, have to borrow in order to buy the land, borrow in order to develop the real estate, here gets a much easier situation, right? So on the one hand, he buys land off cheaply before the infrastructure is developed. On the other hand, he can basically finance development of the real estate through this mortgage lending by the household, because the household buys the claim even before the real estate is developed. And here we have a little bit of data on that as well, on the infrastructure, on the pre-sales, which, as you can see here, have become more and more significant as the years have passed. Now, if you look at the operation that coincides with the shadow banking period, that can work in several different ways, but mainly through trusts, which are set up in order for banks to circumvent the loan to deposit ratio, which was set up to stop them from lending. And basically, as these investments in the trust are not treated as loans, banks can go on and do as much of that as they would. And basically then these trust companies become a channel for providing the financing as it was done beforehand. we have, yeah, this is the whole model here, if you want to look at it. And then we have some data on both borrowing through trusts for real estate developers and general investment of trusts in the sector, which we see basically reached the peak around 2019. So they go on, yeah, from 2008, basically all the time growing to 2019. Now, generally, there was, as Robert already mentioned, clampdown on these shadow banking operations after 2014. That didn't necessarily stop the involvement of trusts in the sector for a long while, but it did set up this new operation or new type of operation, which coincides with what he was talking about, the development of the bond market. And here we have the model based on the local governments borrowing in the bond market and the real estate developers borrowing in the bond market too. And we see that, yes, in fact, this type of borrowing has really risen. There is also another version here that we provide, which is through special purpose vehicles, public-private partnerships that were used for this, relatively similar to the bond market operation. Local government debt issuance. Here we see basically comparison between these two models. General being bonds by local government, and special being related to the special purpose vehicles. And we see how, in fact, special purpose vehicles have been becoming more and more dominant, especially in the last years. So since the new regulation came in. What I want to mention a little bit more is, okay, so what happened recently? So we all know, I'm sure many of you know, that there was a big kind of intentional policy clampdown on the sector, which were these 3 red lines, basically limiting the amount of borrowing that these companies would, real estate developing companies would be able to do. And these are the three ratios. I'm not going to go into that. Basically, depending on how many of them you're going beyond the requirement, you're going to have a harder and harder time borrowing. Now, what I want to talk about is what is happening currently, and there are 2 things that I want to mention here, and one of them is what Robert has already talked about. So let me first say something about that. That is basically the use of short-term repo operations by the central bank, and how that affects the sector is that it props up the price of bonds and the conditions for borrowing for local governments primarily. And we see here that, you know, if someone is talking about like this regulatory clampdown on the real estate sector, at the same time, this sector has been for the last, well, from 2015, but especially so in the last 3 or 4 years, has also been propped up by the central bank through this mechanism. So not directly the real estate developers, but definitely the local governments who play a significant part in protecting the price of real estate, right? So that's one thing that we should have in mind when we think of the liquidity regime in this sector right now. Now, the other one, the other and the last thing I want to comment upon for a second is what has happened in December 2022. So very recently, is that we have had these 16 new policy points, and they're quite extensive. What is interesting about them is so they involve generally what you could imagine, right? So first of all, since the price has gone down and the capacity of real estate developers to borrow has been impeded so much, there have been first some easing on the borrowing conditions, right? And this is clear how this works. There are all kinds of extensions going on, and postponement of repayments and things like that. More interestingly, there is a couple of other things. Let me just mention three of them. So one is that now there is this city-specific approach. So the idea is that there would be specific forms of support provided by local governments based on specific criteria that localities, municipalities are fulfilling, that would then allow people to buy at a cheaper price in those places. Basically, would allow for local government to step in and provide some liquidity in these purchases. Another thing is basically restructuring of the real estate developers sector, basically by selecting out those that were particularly problematic, right? So we have like this kind of channeling of liquidity to those that are deemed appropriate and not risk-taking, and then allowing them to engage in mergers and acquisitions. And finally, what is interesting is that we have also a rental market that is now kind of specifically supported to develop by the government. So these are the things that are just about to happen, or that have been adopted very recently, and we are going to see how they're going to look. What I wanted to kind of give you an insight into is really the specific types of measures that, in a kind of policy-initiated crisis of the real estate sector that we have seen between 2020 and now, we now have a kind of first of all, that throughout the whole period, there was still a level of protection of funding of the sector through the short-term repos using local government bonds. And second, that now when regulators come back in and want to ease this sector, they do it in a, let's say, traditional way by extending the maturities and things like that, but also by kind of selecting out specific parts of this market that they think should be developed, both in terms of the real estate developers and in terms of municipalities, local governments that should be supported, and in terms of specific type of demanders, so rental market versus acquisition of real estate. And that's basically it. So here I'm going to stop sharing the screen, and we can then have a bit of a discussion with these 13 minutes that we are left with. I'm not sure what you guys think, but maybe it would be better to open for a general discussion immediately, since we have so little time, and it would be great to hear people in terms of what they think.
Yeah, let's do that.
Okay. So yeah, we are okay. Jay says that we have 5 more minutes, which is great. 5 additional minutes, meaning 17 minutes now. Now, okay, maybe it would be best if some of you who have posted in chat would speak for a second. I think it would be great for us to hear you, if that's okay, if anyone would like that. And then I'll read out the questions that are there that have not been answered, that have not been read out. So, okay,
Perry has his hand up, so why don't we go there?
Yeah, let's hear Perry.
Well, this is fascinating. I've been following China, but I don't read Chinese, and I'm not in China. And I've had students writing papers about real estate, and so I know a lot about the Chinese students who are writing about the local government and all that sort of thing. But let me just make maybe one comment on each of the three. So Johannes, this idea that the Chinese government is concerned with the real economy. I mean, I could see advertisements like that on Wall Street. They say that too. Okay, but maybe you were saying that they really are concerned with the real economy, as opposed to Wall Street. So the more positive question I have for you is, to what extent are these Stock Connect kind of, this evolution of the connection to the outside world driven in fact by concern about capital controls? So it's not so much about your development model, but concerned about capital flight even of your oligarchs and so forth. So so it's not hot money coming in and out, but so you didn't mention capital controls at all, but of course that's how the capital controls are maintained. Second, Robert, you say, this is a fascinating story. When I got invited after New Lombard Street to various conferences in China on shadow banking, and I looked into it and I said, this isn't what I mean by shadow banking. This is not money market funding of capital market lending. This is regulatory arbitrage of the banking system, really. And so I don't really have anything to offer here. But what you pointed out is it's changed. It now is more money market funding of capital market lending. And you say that it's a change in tone, not of substance. But I wonder about that, because once you have, a lot of the point of New Lombard Street was that shifting to market-based finance does change some of the dynamics of finance, that the dealer system for supporting these markets becomes extremely important. And I think that's sort of implicit there. You're thinking of the central bank as being market maker of the first resort, but perhaps that's just because of crisis, like in crisis time, of course, the central bank, and there has been crisis, but also they haven't really developed maybe a depth of a private dealer system in order. So this is a part of the financial development, that it's being developed by the central bank, but they might back off and allow private. That's how it works in the U.S. anyway. That the central bank is the dealer of last resort. So I guess pushing back. Maybe it's not a change of substance yet. But these institutions this is an important maybe shift. And then for you, Sasha, you talked about the differentiation of the different kind of real estate developers, and there were a lot of questions in the chat about Evergrande. Can you shed any light? We hear that the disfavored, like Evergrande, are the disfavored developers have looked for other sources of funds, in particular issuing commercial paper to Tether, so that I don't know any fact about this because Tether doesn't reveal its balance sheet, but that all makes sense. It seems plausible and possible. Can you shed any light on the sort of mechanics of the meltdown of this, flight to quality? We had this period of elasticity when they're growing this thing, and now they're clamping down, and we have a period of discipline. And there's so those are my three observations.
Thanks, Perry. These are great. Let's hear maybe more, so we can take then like all of the questions, comments together. We have Asger. Maybe he can say something.
Yes, thank you very much. It's fascinating. Those of you who know me know that I worked in the real estate market before my PhD. So this is the other side of the coin, to see the real stuff. And I point out the facts that mortgage is bigger than the stock market, lending to housing. So extremely important. To follow up on Perry's question on the capital controls, I point also towards the Hong Kong situation in this bigger picture, because that's how I see somehow the exit of the capital market from China. But I don't know about China at all, but I was for a while in Hong Kong. So that's just a pointer. The other thing is that to consider this market-based, there is a problem to view money market as any other market, and there's a similar problem to view real estate market as any other market, because it is not like potatoes or supply and demand. It's homes of people, and it's like state building, as I see it from the outside in China. You have this huge GDP growth, you have this huge transfer of people from countryside to cities. So you need to build it. So you need to somehow fund it like this. So you know, I'm pointing or thinking here about like the GDP growth versus real estate growth, or the real estate growth versus GDP growth, you know, the egg and the hen, or like what comes first or what is needed for the other. And that, yeah, it's maybe not a clear picture, but these are like reflections on listening to you three guys of what needs to be done more also on grasping this. Thank you.
Okay, we have Shenbei Guo.
Yeah, thank you. In fact, I went into China in 2015, and in fact, I was in charge of proprietary trading for CITIC securities during that time, and also played a leading role, in fact, in the market crash rescuing operation at that time. In fact, even though I was there very briefly, so I observed. In fact, came back to my home in New York, New Jersey, just a couple of months ago. I observed, in fact, a lot of the changes that in the financial market. So maybe I will just say a few comments. I think there are macro reasoning behind the change of shadow banking. So as Petry pointed out, there was a lot of people in China realized that too. It was more arbitrage. The shadow banking was more of arbitrage, regulatory arbitrage as opposed to real shadow banking. But over time, it did go into that direction. I think there are a lot of macro reasons. I would just point out maybe just one, because by channeling the money into the real estate market, essentially for the bank to release both liability and also the asset at the same time, but of course, releasing the money into the real estate market, what it achieved is increase the level of risk-free rate in the economy. So the real risk-free rate is determined by that channeling process, which earn very high income. So by doing so, of course, the other sectors become uncompetitive. So there is a lot of reasons for, I mean, of course, I'm just pointing out one, but a lot of issues. Later, the direction, the Chinese repo market has indeed become, there are some features, at least some signs of that, things that did become more and more like a real repo market. The bank money market operations, in fact, have a lot of commercial money market features like we observed here. So that's a lot of changes like that. But of course, China made some very bad macro mistakes. About a year and a half ago, in fact, I was observing the thing based in Shanghai at that time. There was talk about how to change from the land sale-based financing scheme for local government into more like a long-term property tax-based approach. So that triggered me to write a piece. In fact, I mentioned this briefly yesterday. I really decided to use Levi-Kalesky profit equation to talk about how Chinese model is so different from everybody else, right? So essentially, it's a profit equals to investment minus household saving plus budget deficit plus current account surplus plus dividends. That's essentially the equation. So what China essentially is doing is through the government involvement, recycling money from the land sale, because only of all the government in the world, only China has the ability to own land directly and or control all financial markets directly. So by doing so, it can recycle what essentially is a financial transaction into the investment process, which drives GDP, of course, through the secondary process, drive consumption and other savings as well. So that process is really gave Chinese economic miracle is a foundation, especially since the export stopped growing as much since 2008. So that process, which essentially is investment-led, is heavily dependent on the property market, but China did not realize it. So that come down to last year, 2022's three red line process. Of course, that's the development process by itself could have a lot of problem. It will naturally slow down, but what China essentially made a colossal mistake in this case, of course, they are trying to reverse that now, is it's introduced by using 3 red lines, introduced essentially a level of systemic risk. So by freezing the bank lending or limiting bank lending to the sector, that essentially turned all the bank lenders or bank loans like almost like the bond portfolio, but all the bond investor become a mezzanine investor or maybe become equity tranche of this lending structure. So that created a huge problem. So that process, of course, caused China was trying to maintain the growth model, but that growth model is heavily dependent on the land sale, and the local government receive money. That money was turned into investment. So of course, China was trying to do other things, which come down to a lot of the because when somebody mentioned earlier about the stock market offering, Chinese stock market offering is very different from other places. It has massive amount of IPO, then it has many times more private placement. Essentially, it's like it's a publicly traded stock. They can offer more stocks regularly. So that process essentially is a way to take people's saving, giving that to the so saving, of course, is not part of GDP, right? So, but taking the saving,
can we come to a question, because like we don't have
I'm just making some comment about that. Sorry. Yeah.
That would,
Okay.
thanks a lot.
That's good. Yeah, I just want to mention about the land thing. Yeah, thank you.
If we knew you would be here, Shanghai, we could have included you as one of the speakers.
That would have been great. Yeah.
Yeah.
No, sorry about that. I went down too long. Sorry about that. Yeah.
No problem at all. No problem at all. Maybe so I'm not going to read questions out loud. I think you guys saw the questions here. So maybe let's go in the order we presented. Let's have maybe Johannes give us a comment, then Robert, and I'll conclude. We have about 9 minutes until the hard stop.
Great. Okay, thank you. I'll try to keep it brief. So I think the 2 comments that I'm addressing are by Petry and Aleksandar. Thank you for those about the capital controls. And I mean, there are lots of ways for Chinese high net worth individuals to get their money out of China, and they've been doing that for years. I mean, now you see Singapore being quite big in the news, but it's for the last 10 or 20 years, you could see Singapore growing as an offshore hub for Chinese wealth management, basically. And that wasn't too much a concern. So there was always money outflows to a certain degree, and but really the reasoning behind the Stock Connect was getting money into the country in a way that's controllable, and really integrating with global markets while staying in the driver's seat, basically. And that's kind of how that process kind of evolved over time. So capital controls, yes, they're important, but it's really more about inbound capital and hot money flowing in and out rather than kind of capital flight. Right. And about the Hong Kong situation, this is where kind of the Hong Kong is the perfect conduit for this kind of controlled opening, because they will in the end do what China tells them to do when it comes to, for instance, turning off the tab on or some restrictions when it comes to these infrastructural arrangements. Singapore wouldn't, for instance. So that's how Hong Kong fits into the picture.
Thanks, Johannes. Robert?
Yeah. So maybe in response to Perry's question, so haven't actually the dynamics of finance changed substantially in China, or aren't they maybe actually in the process of changing substantially? And then so from a technical aspect, yes, of course there is substantial change. My comment about a change in form rather than in substance was more about the question of how does this fit into the idea of an overall liquidity regime, right? And in terms of an overall liquidity regime, I don't see a substantial change. A substantial change here being that we see a change in how credit, or to whom credit is allocated and at what conditions. That hasn't changed substantially. Quite to the contrary, I think that market-based banking, as the People's Bank has engineered it, entrenches in that sense the existing liquidity regime. And then, so maybe there will be a change in the future to make this into a system that actually more resembles market-based banking in other countries. But that is not a technical question, that's a political question. And the issue here is really how do you engineer the kind of political change that is required to convince entrenched interests like local governments, real estate sector, and so on and so on, to give up their privileges in the current liquidity regime. How can the central government think of a different way of macroeconomic steering, right? And I think if we look at political developments over the past years, and especially over the past months, we see that the central government isn't as powerful as some people have made it out to be under Xi Jinping, maybe. Right, so they have moved back from the 3 red lines. They had this sudden COVID policy about turn, of course. They have tried to implement, for example, a taxation of real estate property for like 10 years now almost, without being able to actually implement it because that's against the interests of local governments and the way that they finance themselves, and so on and so on and so on. So this is what I mean when I say that there's not that this is a change in form rather than a change in substance.
Thanks, Robert. Let me try to say a little bit about the questions I had, and then a little bit to wrap up. Perry, I still don't know about Tether. I tried to look it up when you told me about it, but it's quite intransparent. What I've seen with regards to Evergrande has really been about this kind of controlled breakdown, right? Like it's been about, instead of having a full-blown bankruptcy happening, going default by default on a specific bond, right? And then seeing which kind of bond is it, who holds it, and then who gets, you know, paid, and how the money comes in, right? And who doesn't. And this has been what it has been about, and that has been very interesting to observe. So in this paper, we'll have a case study of Evergrande and of China Minsheng Bank, which has been the biggest lender to Evergrande, and potentially a couple of other important actors in that story. I would want to make a general point here, which I think all of our 3 presentations have somehow signaled, which is the interesting, like if we start from the question that Fabian had in the paper, which is about, you know, kind of going behind this, you know, supposedly neutral appearance of money and monetary policy into, you know, showing that there are political and distributional issues behind it, right? When we look at China, that seems to be an obvious thing, right? There doesn't seem to ever really be this kind of neutral appearance according to which, you know, things are just left to the market. Which then brings us to the other question, and I think both our interventions and the questions that you guys had bring out, which is if that is so, where does the appearance of markets still hold, right? To what extent is the price mechanism still allocating things, and you know, who relies upon it, right, in making their own decisions, right? And who, you know, especially when we talk about the capital market in China, who has this kind of insider information about, you know, where the money is going to, yeah, it is Alex, where the money is going to go, who is going to get saved, and so on, right? So I think this is really what is at stake here for us to understand, especially from a money view standpoint, and understanding you know, how basically the monetary system is controlled, and then how that affects the price system, right? To what extent, if we all know that there is a large political game and a lot of selective approach behind the market price mechanism, who and to what extent relies on the prices in the end, and to what's the role of the price mechanism in there? And I think this has really been one of the most puzzling things in looking at China, because it is not the case that at the end of the day, this price mechanism is completely illusionary, right? And fictional and irrelevant, right? It's far from it, right? It's still very much a market-based system, and daily operations by most of the participants are based on this information flow through the prices. And maybe with that, we can conclude, Jay, if you want to say a final word, and maybe we can stop.
I just want to say thank you, because this was a great session, a great way to get us started for the day. And I know that for you, Sasha, and maybe for you, Robert, this is the end of the day. You might not be able to join the rest. I'll quickly pause the recording. We're really happy about